Bonjour à toutes et à tous, et ravi de vous retrouver ce matin. Alors désolé, on commence avec 20 petites minutes de retard, mais on fera en sorte, comme hier après-midi, de rester dans le timing pour toutes les intéressantes discussions et présentations qu'on va avoir ce matin. Alors ce matin, le programme, je pense que vous l'avez vu, on va avoir un keynote de 20 minutes que je vais vous présenter dans quelques instants. Et ensuite, 3 panels de discussion. Un premier panel qui porte sur les changements climatiques et nécessairement comment on adresse aujourd'hui la gestion du risque, la détermination du risque grâce à l'intelligence artificielle. Et puis, petite discussion un peu généraliste sur les changements climatiques et leur impact que ça peut avoir en termes de dommages et essayer d'aller un peu dans le détail sur la manière avec laquelle c'est géré, et notamment par les compagnies de réassurance qui seront fortement représentées dans ce panel. Ça, c'est la première discussion. Ensuite, pause café, on revient, et un troisième panel où là, on va s'intéresser à l'assurance santé. Même mécanisme, comment, avec l'intelligence artificielle, optimiser le parcours santé. Comment aussi l'intelligence artificielle est utilisée en médecine, parce que ça va être lié nécessairement à la détermination du risque, à la couverture, à la détermination des primes. Et enfin, dernier panel, alors ça sera moins une discussion, mais ça sera plus une présentation de différents use cases dans différentes branches de l'assurance. Et là, on aura un retour d'expérience sur l'intégration de l'IA. Et donc là, ça sera extrêmement intéressant également, puisqu'on aura des réponses concrètes. Voilà, je vous ai un peu dressé le planning de la matinée. N'oubliez pas, vous avez vu un QR code qui s'est affiché. Si vous voulez retrouver vos photos, on utilise l'intelligence artificielle aussi, avec cette application qui s'appelle Memento. Voilà, vous avez le QR code. Vous scannez le QR code, vous allez arriver sur une appli. Vous prenez un beau selfie pour que l'intelligence artificielle puisse vous reconnaître et aller chercher votre photo dans toutes les photos qui ont été prises, et vous pourrez les télécharger directement. Si on vous envoie les photos de quelqu'un d'autre, c'est que vous vous ressemblez fortement. Voilà. OK. Other thing, I'm going to switch to English. Yesterday we had a French-speaking panel and an English-speaking panel. Today, the specificity is maybe we're going to have to swing between the 2 languages in each panel. So we will have translation headsets for the panelists, but you can use a translation headsets before you go into the room. Don't forget, it's at the back of the room. Okay, so let's start with our first speaker. She will have 20 minutes to address a very important question about the AI health insurance equation. How can we strike the right balance between personalized offerings, we talked about that yesterday, and risk pooling? Ladies and gentlemen, please welcome Mrs. Bodzena Hinton. She's the president of the International Actuarial Association. Please, Bodzena, you have 20 minutes to answer this very important question. Thank you.
Bonjour. Dear distinguished guests, Madam Minister of Economy and Finance, Nadia Feta, Monsieur le President of the Moroccan Insurance Federation, Mohamed Hassan Benzala, Monsieur le President of the Insurance and Social Security Supervisory Authority, Abderrahim Shafai, represented by his General Secretary, Mr. Othman El Alami, Mr. Seth Kobler Aglasi, President of the Ghana Insurance Association, Ms. Petra Halkema, President of the European Insurance and Occupation Pensions Authority, Ms. Florence Lussmann, President of France Insurers, and other attendees. My name is Bodzena Hinton. It is my great privilege to address you today as the President of the International Actuarial Association. I am delighted to be speaking to you about how to balance personalisation of insurance offerings and risk poolings with AI. This balance not only impacts the profitability of our businesses, but also the fundamental social value that insurance provides to society. My presentation today covers 3 areas. First, the foundation of insurance, being risk pooling and its core principles. Second, how personalisation has evolved within insurance models. And thirdly, how AI is transforming this balance, creating both opportunities and challenges for insurers worldwide. Insurance begins with risk pooling. By grouping together policyholders, we transform unpredictable individual losses into predictable collective outcomes. This allows us to provide financial protection at a fraction of the potential cost of losses. However, for this system to work effectively, several fundamental principles must be respected. These principles are central to risk pooling and can be summarised as measurability and definability, randomness of claims, no financial incentive to claim, premium affordability, portfolio risk management, and a large, statistically sound customer base. These principles must be met for insurance to be offered, and I'll now go over each one in a bit more detail. Firstly, measurability and definability. This requires that both the probability of a claim occurring and the potential size of loss must be quantifiable and clearly defined. For example, for earthquake coverage, you need to be able to estimate both the frequency of events and the extent of damage to estimate claim payouts. Secondly, randomness of claims requires that claims must result from genuinely random, unforeseen events, rather than being able to be manipulated by a claimant. The loss must be truly accidental or unexpected. Meeting this principle ensures that the risk pool functions properly and prevents moral hazard. For example, a property owner shouldn't be able to buy fire insurance and then deliberately set fire to their building to collect the sum insured. A customer with a known terminal illness should not generally be able to purchase life insurance. Insurance covers unexpected events, not deliberate actions or inevitable outcomes. The third principle, no financial incentive to claim, addresses another aspect of moral hazard. We need to ensure that insurance compensates actual losses without creating profit opportunities. Claimants should not be financially better off after a claim, and products should include appropriate waiting periods, benefit limitations, or other controls. For example, disability income insurance should be designed to only replace a portion of income to ensure that claimants maintain their motivation to return to work when medically able. The fourth principle, premium affordability, recognises that if premiums are too high, some potential customers won't be able to purchase cover. At this point, only customers who really think they might claim are likely to purchase. The healthy or lower risk customers are likely to decide to take on the risk themselves and self-insure, leaving only a small number of higher risk customers in the pool. The fifth principle, portfolio risk management, acknowledges that insurers must carefully manage their insured risk to protect their financial stability. And they do this by diversifying across geographic regions, limiting concentrations in any single risk category, using reinsurance, maintaining capital reserves, and adjusting underwriting criteria as risk factors evolve. The last principle, a large statistically sound customer base, refers to insurance requiring a sufficiently large pool of policyholders. And this is necessary to allow the law of large numbers to operate effectively, to create predictable aggregate claim patterns, to spread risk, to enable accurate pricing, and to ensure stable performance over time. While risk pooling remains the foundation of insurance, the industry has increasingly moved towards personalisation. This evolution responds to market demands for fairness and efficiency, but creates tension with traditional pooling principles. Let's look at why personalisation matters and how it transforms our approach to insurance. So why do we personalise? Insurance risk pools traditionally spread the risk across many policyholders, but personalisation has become increasingly important. Every customer is different. Personalisation of insurance allows us to adjust for these differences. Some reasons for introducing personalisation are pricing fairness. Without personalisation, low-risk individuals effectively subsidise high-risk individuals. For example, in life or health insurance, where generally older and sicker people are more likely to claim, if we charge the same premium to everyone, then the younger, healthier people will be cross-subsidising others. This sometimes can be a deliberate strategy, such as the private health insurance system in Australia. Community rating applies where premiums do not vary by age. Family cover is charged only twice the single cover. However, this cross-subsidisation makes it very expensive for the young singles to buy cover, and many choose not to. Another reason for personalisation is to prevent deterioration of the risk pool. If the price of insurance does not reflect the risk, then the better risk individuals may not find the price of cover worth the cost of the premium and choose not to join the insurance pool. Personalisation of insurance can provide incentives to reduce the risk. We can introduce policy terms and conditions that can encourage positive behaviour. For example, some policyholder actions that can result in lower premiums are garaging your car rather than parking it on the street, installing window locks or home security systems, or stopping smoking. Market competition can also drive more personalisation. Insurers who can better segment and price risk with lower premiums or better terms provided to the lower risk customers can attract these customers. And this can create a positive cycle, with lower risk customers resulting in lower claims, enabling lower prices. Personalisation, when done properly, creates a more sustainable insurance model by aligning premiums with the actual risk and ensuring that low-risk individuals remain in the pool rather than opting out entirely. Now we know why personalisation is important. How can we personalise our offerings? We can personalise insurance by offering different premiums or by offering different benefit terms and conditions. Premiums can be personalised based on factors statistically linked to claim likelihood, such as age or gender or location, occupation, medical history, credit-based insurance scores, or past claims history, where you could introduce a no claims bonus or introduce a premium loading following the occurrence of claims. Personalisation can also occur to the product itself by changing benefit terms and conditions, and this can enable individuals to tailor the insurance to their specific needs. This could include offering optional levels of additional cover. For example, the health insurance, you could choose to pay more to include cover for pregnancy and childbirth, or you may decide that you don't need this option. Similarly, you may choose to pay an additional premium for psychiatric services, or for weight loss cover, or for joint replacement, or not. In disability income insurance, you may choose to have a shorter waiting period, or the option to have benefit indexation apply in the event of a claim. Another type of personalisation is offering an adjustable deductible. Some customers may prefer a low deductible, while others are comfortable bearing more of the risks themselves. For example, with health insurance, you could choose to pay, say, the first $50 of a claim or the first $500. Or with car rentals, you could choose to pay more to insure the amount of the excess if you do have a claim. Some insurers also offer pay-as-you-go or usage-based options. And one example is Metromile in the United States, which charges a fixed monthly rate plus a per-mile charge based on the actual distance driven, using an app and a sensor attached to the vehicle. This means that customers who have a lower risk exposure, as they don't drive much, will end up paying less. The balance between personalisation and risk pooling is the central dilemma of modern insurance. The more precisely we can predict individual risk and implement personalisation, the less effective traditional risk pooling becomes, and the closer insurance moves towards simply pre-collecting expected losses rather than spreading unexpected ones. In the extreme case, the highest risk individuals effectively become a pool of one and become uninsurable as their premiums approach expected loss. This undermines the social purpose of insurance. While a fair approach to insurance involves some personalisation, the question is how much? We're in an era where consumer expectations are shifting. Policyholders increasingly demand policies that are tailored to their specific needs, behaviours and risks. The modern consumer is no longer content with one-size-all-fits insurance. Customers expect more tailored experiences, and they're willing to share data in exchange for more customised coverage. Artificial intelligence represents the next frontier in insurance personalisation. Technology can analyse vast data sets to identify risk patterns with unprecedented precision, fundamentally changing how we underwrite, price, and manage insurance products. And while many of us have experienced AI through tools like ChatGPT, its impact on insurance extends beyond automation. So what does this mean for insurance? As well as the operational improvements in claim assessment, fraud detection, and customer service, opportunities exist to better classify risks and hence charge premiums more reflective of the customer's risk profile. In underwriting, AI can be used to quickly extract key information and to automate data entry tasks. It can also be used for decision-making, though caution is needed to ensure explainability and that any inherent biases in the training data are not perpetuated. In data analysis, AI can extract meaningful patterns from non-traditional data like social media activity, shopping patterns, or property imagery to supplement conventional risk factors. For example, AI can interpret data from wearable devices to look at complex patterns in activity, sleep, and vital signs to create more nuanced health risk profiles in life and health insurance. In pricing, AI can be used to carry out multivariable analysis and simultaneously analyse hundreds of risk factors and their complex interactions, increasing model sophistication. And this can lead to more accurate pricing for the identified risks. For example, AI can analyse telematics driving data to specific risky behaviours such as hard braking, acceleration patterns, and distracted driving, rather than just basic metrics about the car, make, and model. So, given this potential, how should the industry respond? In this environment, market rules or regulation can be used to achieve desired outcomes. Some examples of this are regulatory constraints on certain rating factors. And we've seen this already in the EU 2012 Gender Directive that prohibits insurers charging different prices based on gender. Another example is that in 2024, the Australian government announced a total ban on the use of adverse genetic test results in life insurance underwriting. and the UK and Canada already have such bans in place. Another constraint is imposing rate bans that limit the maximum premium difference between the highest and the lowest risk categories. For example, China has imposed a requirement that insurers can charge only up to 15% more to cover electric vehicles than to cover non-electric vehicles, in spite of their much higher repair costs. Products can be structured based on pools or guarantees. For example, in group life insurance, some guaranteed cover is provided based on the person's age. In the extreme, there may be high-risk pools or government backstops for otherwise uninsurable risks. And in Australia, the government has implemented a reinsurance pool for insurance companies to transfer their risks for cyclones and cyclone-related flood damage. Data privacy rules may also be imposed on the collection and use of data, such as the EU's General Data Protection Regulation, with its restrictions on the use of personal data. It's possible that should AI sophistication result in higher levels of personalisation that is deemed as the public good, then governments or regulators will impose rules to prevent this and enforce greater pooling. As a final consideration, when using AI tools in insurance pricing, it's essential to be mindful of explainability, the need to ensure that AI decisions can be explained to regulators and customers. Fairness, preventing unintentional discrimination or bias in AI-driven personalisation. Privacy, balancing personalisation benefits against data privacy expectations. Compliance, adhering to evolving regulations around the use of AI in insurance. And ethical considerations, the ability to collect and analyse vast amounts of personal data which can inadvertently lead to discrimination. In conclusion, it's important to remember that the future of insurance depends on maintaining a delicate balance. On one side, we have risk pooling, a collective approach that has defined insurance for centuries. And on the other, we have personalisation, accelerated by AI and responding to market demands for fairness and customisation. Finding the right balance is not merely a technical challenge, but a societal one. It requires us to answer fundamental questions about what insurance should be. Is it a perfectly calibrated risk prediction mechanism, or a system of social protection that spreads the financial burden of misfortune? The likely answer lies somewhere in between, with AI serving not as a replacement for traditional insurance principles, but as a tool to enhance them, creating products that are both more personalised and more accessible. This is the balance we must strive for as we navigate the future of insurance.
Thank you. Thank you so much, Bazena, for this presentation.